time for the, can I use markers? Can't tell the time. It's just one. All right. You ready? All right. Good morning. Oh, come on, it's Wednesday, you should be half awake, at least half awake, so good morning.
Good morning.
All right, okay, listen, this is the part that everyone feels is the hardest. And it's kind of one of those self-fulfilling prophecies. If you think you won't get this, you won't. But it is very simple. It's just simple math. And it's knowing where things are going and just taking a second and figuring out. There's three basic financial forms that we're going to use here that you're going to go over today. You need to know what they are. Okay? The first one is a cash flow statement. Okay. Now, lots of banks will use these things. Some people call them sources and uses of cash, which really works out well. What is the number one reason for a business to go out of business? 99.9% of all businesses go out of business because of what?
Low in cash.
They have no cash. Yeah, they can't pay their bills. Now, obviously, that might be a problem because they don't have any customers. You know, or they're just spending too much money on things. But ultimately, it comes down, businesses go out of business because of cash flow problems. You've got $4,000 in payroll to make tomorrow, and you've got $200 in the bank. Or for us, we had a $5,000 rent check we had to come up with each month. 2 days before you're looking at it, where am I going to get this money? And this is very similar to just the registering your checkbook. So you deposit money, and you take money out. For us, when we had credit cards, about half of our income came from credit cards, which was really nice, because we knew in 48 hours that would be deposited into our checking account. Checks, you deposit them in your account, you get credit for them, but then you had to worry about whether they bounced or not. The cash, obviously, just got credited to you immediately. And so what I would do is each morning, I would just come in and say, this is how much I have going in, and I would just keep up a little list here. And I know I've got this much in credit cards coming in. And then I would try to anticipate, what am I going to have happening over the next month or two? And so just always kind of figure out where my cash was coming from. Because you don't want to get stuck not being able to pay that rent check. You don't want to get stuck not being able to make your payroll or paying the IRS on funds that you know. So basically, it's just like a checkbook register. Money in, money out. I'll get this much in today. I've got this bill to pay today. I've got this one to pay tomorrow. This one always hits on the 30th of the month. I've got to pay them, and you just accordingly do it. So it's really pretty simple. It's just cash in, cash out, sources and uses of cash. Where's my cash coming from? I got to borrow a little bit of money this month to get through. You know what? Some businesses, our Burger King in Wyoming, for instance, our best months were June, July, August, and December. June, July, August, because we were on Interstate 80, and we were the main line between basically, say, New York and California. And so a lot of people traveled that road, and obviously did so more in the summertime for vacations. And so our business would triple in the summer. And then for Christmas, it's interesting, is the busiest day of the year at our restaurant was always the Saturday before Christmas. And we were just in a town of 30,000 people, but just I think everybody came out and ate that day. So cash flow. So we have to really take a look at where our money's coming from. The winter months, January, February, were really lean. Sometimes the roads would be lousy out there, a lot of ice, a lot of snow, so things slow down. We'd go 20, 30 days where the high temperature would never get above zero. And so people just didn't really feel like going out and getting a Whopper that day. So you have to kind of be careful. Where's our money coming from? Watch our labor. But we still had the same amount of rent we had to pay each week. Our utilities obviously would go up because of heat. And so we had a lot of things to take into account. So cash flow is nothing. It's where your money's coming from, where it's going. Okay? All right. Next one we're going to talk about is income statement. Now, the nice thing is, of all these, we have decided to call them all sorts of different names, and they all mean the same thing. Okay, an income statement is the same thing as a profit and loss statement. P&L. You've heard it called P&L a lot of times. Profit and loss. Now, on those annual reports that I have you order, you're going to find out that everybody calls their sheets a little bit different. They might say consolidated this or that, but they're all three the basic ones we're going to talk about here today. They all have those same basic components to it. In any business that you have, you're going to have to do a P&L or an income statement. And there's only 3 parts to it. And, same thing with a balance sheet. There's only 3 parts to a balance sheet. It's just learning these things and what goes where. Now, a P&L is done over a certain period of time. It's from this date to this date. And generally you'll see these done on a monthly basis. Could be a weekly basis. Definitely a quarterly basis for your bigger companies. And then obviously a yearly basis. So you can end up doing your taxes. All right, so an income statement is done from this date to this date. So you're always picking a date there. It could be done on a daily basis. The first thing, what's the most important thing in any business, the number that you want to track? What's your number one number you're going to track?
How much you sell?
Right, sales. Okay, so we say income. Also known as sales. All right. That's our number one thing. How much did we do in sales? But that can't be our only number. Because in order to say, well, we brought a lot of money in, but yeah, we spent a lot of money, it would not be good. So, good sales. So this is our dollar amount on sales. Now, we subtract from it what? Our expenses. Now, here's where it gets a little tricky, and everyone's going to say, oh, I can't understand that, and they're going to shut down. Expenses. There's 2 types of expenses that we will pull out of this. And the first expenses are what we call variable expenses. And from that, we subtract out these variable expenses, and we get our gross profit. Remember on Shark Tank, what's your gross? How much did you gross? Those are the things that you've got to have that to be able to do it. So these are variable expenses. These are the expenses that relate directly to your sales. That if you did not make that sale, you would not incur that expense. So let's take a look at a McDonald's. You drive up to McDonald's. What expense have they had to pay for you so far? McDonald's will pay for gas.
The parking lot.
What expense have they pay for you specifically so far?
Nothing.
Nothing. Good answer. Now you walk in the door, you open the door. Nothing, right? You go up to the counter, they haven't had to make any expenses yet. But you order a hamburger. Okay, what expenses have they had incurred now?
Workers.
Okay, we have some labor, right? Somebody that made the hamburger and somebody that actually put it across the counter. What's the most important expenses they have right now?
Actually.
Okay, all right, so we've got the food cost for it. So we've got the bun, right? What else?
The meat.
Patty,
Cheese.
cheese, lettuce, tomato, condiments, good. What else?
Fries.
No, we're just talking about the burger. Come on. 2 more real big things. What? Oh, pickles. Okay, well, pickles. Okay, the bag. But what before it goes in the bag?
The wrapper.
The wrapper. Okay. Okay. You get a drink. What do you got?
A cup.
Cup. Straw.
Lid.
Lid.
Ice.
Okay. Ice.
And the drink.
Okay, and the drink that goes in the thing. So, so you can see all these little things that go into it, right? And then your labor. So our variable expenses here are going to be all these things plus a little bit of hourly labor that had to be used to fix those things for you. Now, on our labor, there's 2 distinct parts. We're going to talk about hourly labor and basically management labor. Okay, hourly labor is if you had no business, you wouldn't need those people there. So these become our variable expenses. These are expenses that vary directly with a sale. So if we have a sale, we've incurred these things. Now, McDonald's gives this stuff to us, the burger, the patty, the bun, the wrapper, all those things, and we give them what? Money. So it's a transaction that benefits both sides, right? And you go out there and then you eat your thing. So we have all these things. So these are what it is. Now we come up with our gross profit. I say hamburger right now. Let's see. Oh, let's say the one I always get is the McDouble. It costs me $1. 16 now. It's $1.16. And then cost on it is these are kind of expensive. This is probably about 80 cents. And so their gross profit is 36 cents. There's two items that fast food places make their money off of. What are their two items that they make their money off of? Two items that they make most of their money off of.
Fries?
Drinks and fries. Very good. Fries. Just to kind of give you an idea. 100 pounds of fries will make 340 regular sized servings of fries. 100 pounds of fries will cost you $15, and 100, the regular order of fries will be $345. So you can see the profit level in that. Plus, if you got shortening, you got some other things you got to put in there, but that's where the money is. The drinks, iced tea, costs you a bag about 5 cents, makes you 5 gallons, especially if it's unsweet. The stuff's cost you basically nothing, and you can sell it for quite a bit. So, that's where the profit is in those things. All right, so we come down here, we have our variable expenses. That's taking care of all of our food, the hourly labor associated with it. We have our gross profit. Now we want to take our other expenses. We're going to call these fixed expenses. Okay. Now, fixed expenses are those expenses that, let's say this McDonald's was closed for a day for some reason. What expenses would they still incur whether they were open or closed?
Electricity.
Huh? What's that?
Rent.
Rent, yes, very good. What else? Electricity, good. What else? Okay, all the utilities. How about internet? Telephone? Insurance? All that, right? Management salaries? All those things that they would have to pay. Taxes, property taxes, all those things. So those are expenses that they're fixed. Means they're not going to go away whether they're open, closed, no matter how much business they do, they're still going to have these expenses. Does the utilities, and this has changed really much if you have twice as many people come in. It's not a significant amount. I mean, you're going to use more toilet paper, and toilet might flush a little bit more, but basically the cost is the same. Your insurance is going to be the same, your management labor is going to be the same, taxes, all those things are going to be the same. So this has nothing to do with the number of customers that come through on your fixed expenses. This has everything to do with your customers. Getting that product across to the customer, getting it sold, because nothing happens until customer makes a purchasing decision. And that's what this is right here. This is that purchasing decision from the customer. Okay? So all we're looking at here is on our income statements, how much we bring in. We subtract out our variable expense, we get gross profit. We subtract out our fixed expenses, and now we get our net profit. So net profit. So everything else, all of our expenses are going to fit into one of two categories, fixed or variable. And that's what you need to do. Now, this variable expenses, you will many times hear COGS, COGS, cost of goods sold. So a lot of times you'll see it listed, instead of variable, you're going to see it listed as COGS, cost of goods sold. So this is a number, these two mean the same thing. Like I said, all we're trying to do is confuse you at this point, using multiple names for the exact same thing. Okay. The income statement, profit and loss, Exactly the same thing. There's no difference between them, okay? And those you just have to know. And there'll be some, on your annual reports, you'll see them called something else, but you can always tell what they are because they're always going to have sales, cost of goods sold, fixed costs, gross profit, net profit. You'll always see those listed on there. And when you look at these Shark Tanks now, a lot of times you'll hear them say, what is your gross? What is your gross? That's what they're really concerned about because they want to know is how much of a spread you have between what you charge and what you end up making just off the cost of that good sold. Let's see, think about, well, let's say a roller coaster ride. What is the gross profit on a roller coaster? Let's say someone goes up and pays $1 for a roller coaster ride. What's the gross profit on a roller coaster ride? A lot of people want to ride it, so what do you think the gross profit is? What are their expenses? Their fixed expenses and their variable expenses. Okay, electricity. Would be what? Fixed or variable? Fixed.
Everything's
So their variable cost would be what?
zero.
Zero, very good. So you have some things that have almost a zero variable cost. Or you can just say the cost of the first person riding it is, $50,000 and the rest of it is just profit from that. But, so you can see in different types of things. And so on a roller coaster, you've got to have a large number of people to come ride it because of the fixed costs. Maintenance is going to be expensive, painting it, crew to run it. So all these things. Crew you could kind of say is somewhat variable, but still you're going to have a very low variable cost there, right? On something like that. So, it's really interesting how this all plays out. So what you're going to be looking at here is 3 simple things, okay? Income or sales, cost of goods sold or variable cost, and our fixed costs. And that's it. We come up with 2 numbers, gross profit and net profit. All right? What I'm going to do too is, if y'all want to, is after this, if you want to come up and take a picture of it, you can. And here's where we get real confusing. This one is the balance sheet. Okay. However, the best name for it is one that's used the least amount. The statement of financial condition or position. Okay. What? Yes. All right. Statement of financial condition or position, or balance sheet is one that's most commonly called. This is just like a photograph. Isn't that a good camera? It's just a photograph. It's a snapshot in time. Okay, where this one is from this date to this date. This is at this time. This is what our statement of financial position is. And there's, again, 3 main parts on this one. There's one accounting equation that you've got to memorize, all right? Because you'll see these things all sorts of different orders. And the thing I want you to memorize is assets equals liabilities plus net worth. Assets equals liabilities plus net worth. You got to memorize that. And then you have to remember, it's just like an algebraic equation. So net worth would be assets minus liabilities. So sometimes you have to move them around a little bit. But the first thing here, obviously, that we're going to have is assets. Okay. Assets are anything of value, anything that will last us for more than about a year. We consider it to be an asset. And here's the other thing. On assets, we're going to list them. What are some assets? Give me some assets that a business might have. Somebody's got some value to it, lasts over a year. Jewelry. Okay, if they're a jewelry store, they're selling jewelry. What else? Give me some equipment.
Cash
So-
register.
Now, let's take a look at jewelry store. So cash register,
Phone.
phone, what else?
Cases.
The cases you put the jewelry in. What else?
Chairs.
Chairs, people sit. Huh?
Cameras.
Cameras for surveillance.
Property.
The building itself. All those things. So what we do is, on our listing our assets, we're going to list our assets in a particular order. And here's a word you need to know, liquidity. What does liquidity mean? Very good. Well, liquidity, I was going to say, it was like water, it flows, but it's how quickly you can turn it into cash without losing
Money.
its
Oh.
value. Okay? Now, does it take a while to sell a house?
Yes.
If I wanted to sell my house tonight, would I be able to sell my house tonight?
No.
Yeah.
Well,
Let's try that again.
Yes.
If I want to sell my house tonight, could I sell my house tonight?
Yeah.
Yes, but I'd have to do what?
sell for a
Drop
lot
the price.
less.
Sell for a lot less than what it is. Do you think there's somebody who's going to come up? One of my neighbors says, "Hey, guy, neighbor Bob." Anybody watch Pearls and Swine? Neighbor Bob, I decided I want to move. I'll sell you my house for $1,000. Do you think neighbor Bob would want to buy it? Yeah. So the thing is you can always sell something right away, but you have to do well with the price. You have to lower it substantially. Everything's got a value to it. So we call that, we're going to use the word liquidity. Liquidity is being able to sell it for its value without losing its value. Turning it into cash without losing its value. And obviously the most liquid of all of our assets is what? That we have in a business. No? Buildings aren't liquid. You just told me buildings take a while to sell. Employees, you can't sell employees. You're not allowed to buy and sell employees.
Equipment.
Product.
Nope.
Money.
Cash! Somebody said cash register, right? What's in your cash register?
Money.
Money. So of our assets, cash is our most liquid. So one is going to be liquid. Now, here's the other thing. This is going to be, as you start thinking about this, you'll start understanding what liquidity means. The next one is probably going to have the highest value to it, is going to be our inventories. Why? Because you got competitors, right? So if I have, let's see, some of y'all doing restaurants, right? So all the food in my place, do other restaurants use that food? Do you think another restaurant would say, hey, if I gave you 15 or 20% off on the stuff I just bought from US Foods, would you be interested in buying it? Well, yeah, as long as you can ensure that's safe and it's good quality. So inventories tend to be some of our more liquid items. Now we start getting down into things that become harder and harder to sell. What about our cash register? Our equipment? Will people buy it?
Yeah.
What do they want?
A discount.
A substantial discount, right? Anybody ever go buy stuff at a flea market, used stuff at a flea market? Or bought something from a friend, you want a substantial discount on it, right? So your equipment's going to come down here, furnishings. How about the carpet on the floor? Is that worth anything to anybody? Because you put it in your garage, doghouse, right? So we come down to things. These things on the bottom, we're going to categorize into one group. We're going to call them leasehold improvements. Leasehold improvements are going to be things like carpet on the floor here. It's got some value. These ceiling tiles have some value, right? So all this stuff has some value, but once you're down there, people aren't going to give you anywhere near what it cost you for it. But the stuff has some value. So what we do is we list these in order of liquidity, from the highest liquidity to the lowest liquidity. Okay, so that's liquidity. We order all of our assets in a particular order of liquidity. How long will it take us to turn that into cash without losing its value? And if we talk about property, well, people aren't going to really rush in and buy something unless it's really, really inexpensive. You know, it's worth their while because they're going to take a little bit of a risk. They got to think about it, how they're going to finance it. They can do all these things. We make it cheap enough they don't have to worry about that. They're going to take it. Does that make sense? Okay, so that's our assets. Okay. So we have our assets. Next we have our liabilities. And we're going to divide our liabilities into two groups. Now we said our assets are anything that has value. Anything that has value is our assets. Now what's our liabilities? What's a liability?
Something you gotta pay for.
No.
Doesn't have.
So you have to pay for assets. You go out and buy a car, you usually get a what? To pay for the car.
Insurance. Loan.
A loan. Go out and buy a house, you usually get a loan to buy a house. So a liability is anything you owe money on. Credit card. Use credit card to go out and buy a pair of shoes. Do you actually own the shoes outright right now? No, the credit card company owns them until you pay them back. If you buy a car, the person that lent you the money on the car owns the car. If you buy a house, your mortgage company owns the house until such time as you've paid it off. So a liability is anything that we owe money on. It could be, you know, with me, we used to do our payroll twice a month. We paid the wages from the 1st to the 15th, we paid them on the 22nd of the month. And then the 16th through the last day of the month, we paid on the 7th of the following month. So we would have a liability starting on the 1st or the 15th of each month for payroll that we hadn't paid out yet. So that's a liability. So liability is anything that we owe. Could be our electricity bill, credit card payment. Now we're going to divide our liabilities though into two groups. We're going to call them current and then long-term. Okay. Current is 0 to 12 months, 1 year or less. And this is over 1 year. Is long-term. Why do you think an investor would want to know how much you owe in liabilities in the first year versus what you owe after that? What's the magic about the first year? It's going to tell how much you're going to have to pay out those first few months and to help decide whether or not you got enough cash flow to do it. Because if your liabilities are so expensive and you're not bringing in that much money, you're going to go out of business before you ever really started. So this current liabilities have got to be enough where the business can pay them. And a lot of times what people will do, remember we looked at profit, looked at Shark Tank, you know, what are your current liabilities, your long-term liabilities? Profit, we'll get quite a bit more into these when we start taking a look at some of these. Can we take some of these current liabilities and make them into long-term liabilities? Can we take some of these things and just kind of spread out the payments to where we have enough cash flow coming in to be able to support the business? And remember, it all comes down to our cash flow here. Do we have enough money to pay that thing? Because we don't want to default on a payment, default on a rent, default on the IRS, and have them come shut us down. So it becomes very important to make sure that you've got sufficient funds there. And then anything that's over 1 year in length is long-term liabilities. Gives us a little bit of breathing room. Try and get our act together during that first year. So this is going to be anything. Credit card payments, payroll, taxes that we're going to owe, rent, all those things fall into here. Okay, so we have assets, liabilities. Last one is what? Come on guys, what's the last one? Told you memorize that equation. Assets equals liabilities plus net worth. Okay, net worth. Okay, nice thing about net worth is called 14 different things. Okay? So basically, it's net worth. It's what's left over after we take our assets, subtract our liabilities. This is what the business is actually worth. Some places will call it capital. Some will call it owner's equity. Some just call it equity. It's what's left over after everything is paid off. Now, this is the thing that gets really confusing. Now, really watch on this part. See this one where it says net worth? And this one where it says net profit? Right? I want you to think about this one as Michael Jordan, Michael Wayne. I have all the talent, he has all the money. But is there anything that makes Michael Jordan and Michael Wayne similar? First name only, isn't it? Right? I think he might be a little taller than I am. Yes? Probably has a little bit more money than I do. If I remember right, doesn't he play baseball better than I do?
Yeah.
Doesn't he have some shoes too that he wears? He calls his shoes by names, Michael Jordan. All right. So the only thing that's similar is the first name, right? So think about it this way. We see net profit, net worth. Only thing similar with those is the first name, net. So when you get those, don't let them get confused, because this is the one thing that seems to be the most confusing for people is net profit, net worth. Net profit is how much is left over after we made that sale on that one particular item. Net worth is how much is left over if we're getting rid of the business, or we want to value the business. How much is it worth? Okay, so income statements, balance sheets. I'm going to do this exact same lecture 2 more times. You're going to have 5 tests on this. And it will be 1/3 of your final exam. No, I'm not. But that's how important this stuff is. You're going to know this. I'm going to tell you, this is where the bank will hit you the hardest. She's going to look at your financial statements. Okay? It's really very, very simple. And I've got some templates, and we'll go over it on the computer here in a while, but once you start looking at this stuff and getting an idea for it, okay? Cash flow is source and use of cash. Where does our money come from? Where's it going? We're always taking a look at how we're spending our money. Income statement, P&L. Okay, this is from a certain time period. We did this much in sales. This much was our cost of goods sold. Here's what our net profit is after we subtract out our fixed expenses. This one, our balance sheet. What's our company actually worth? Here's our assets. Here's our cash on down. Here's our liabilities, money that we have to pay out. Subtract those two, we end up with our net worth, our equity, what we have left in this thing that we call ours. All right. Okay, any questions? Guys, it's important to get to know what things go where. And some of these things, a variable expense could be a fixed expense for some other company. Let's take an aluminum manufacturer. How do you produce aluminum? What do you use to produce aluminum with? Besides the aluminum ore, use what? Electricity. So electricity for them is a variable expense. For everybody else in the world, it's a fixed expense. So for some people it might be variable expense, some people it might be fixed expense. So you have to take a look at each individual business that you're looking at to figure out what are variable expenses, what are fixed expenses. And then same thing over here. Okay, why don't you